I got started in value investing actually in the late 70s. I read an article in Forbes about Benjamin Graham. And probably coming from Columbia, most of you know Benjamin Graham. The article was about sort of what I considered sort of a secret formula. What caught my eye was he had a formula that said, gee, if you just buy stocks that meet these particular statistics, you can make a lot of money. And of course, I was a student in college then, and if there was a formula to make a lot of money, that was kind of interesting to me. And it got me hooked really on figuring out what this was all about. And of course, that was Graham's net formula, and it was a simple formula, just figuring out using balance sheet items if you could buy a company for less than its liquidation value. That was probably a pretty good bargain. So I found that pretty interesting, and I got a couple of my cohorts in MBA school. Unfortunately, I went to Wharton, and they don't teach any value investing there still. So back in the late 70s, this was probably something pretty new to them anyway. But we actually did a test of Ben Graham's net nets, and they don't have. They were called net nets, which are stocks selling below their net current asset value. And that was his what he would call his liquidation value. And forgetting the details, it was very hard at that time to get databases that could screen through all these companies to get them. So we actually used these old Standard & Poor's stock guides that came out every month. And there was a list of about 6,000 companies in each little guide, and they had some statistics on them. And actually, me and my cohorts, my MBA cohorts, we actually went month by month through the 5,000 companies in the S&P stock guide for 8 years, as opposed to knowing how to run the computer or having access to the computer. And we manually did this. And then a friend of mine who knew a little about computers that they had at Wharton at that time, something called the DEC 10, the Digital Equipment 10, which was a little bigger than this room, the computer. And it had all the flashing lights and reels and everything. And it's sort of, for those of you who remember Lost in Space, that robot, this was less high-tech than that robot, this computer. But anyway, so we got all this data that we had collected over months of writing down prices and, balance sheet items and everything else for these companies. And we actually ran a test showing that just buying these net nets, these stocks selling below liquidation value, in fact, you really could do incredibly well. And in fact, Graham used this method for over 30 years for part of his portfolio. And it looks like the mic's working. Okay. So that was very fascinating to me. I think the results were phenomenal. And I was always interested in not working that hard, really. And so if there was a magic formula that really could, make me not work too hard and make a lot of money, I thought that was like a great thing. And unfortunately, what happened starting in the early 80s when stocks started to move up, Graham formulated his formula during the Depression era, and when people weren't willing to pay a lot for stocks, or at least they thought stocks were a lot riskier and they were bargains. And pretty soon after the boom in the early 80s happened with stocks, most of the net liquidation value bargains that Graham had found didn't exist anymore. So the magic formula was sort of gone. But I did pick up on the fact that value works. In other words, if you can buy something for a lot less than you think it's worth, that makes a lot of sense, and went into the business doing that. And in fact, the studies over the years have showed that value does work over time, whether it's low price book, low PE, low price to sales, low price to dividend, low price cash flow. Tons of studies over the years have shown that that kind of methodology works really well. But in comes Warren Buffett saying, gee, cheap is really good and cheap works, but what if we could buy good and cheap? In other words, what if we could buy a good company cheaply? And, that made a lot of sense to me. And now the net nets were gone, I had to come up with some other strategy that was kind of easy. So actually, what we did was we tried to update sort of Graham's magic formula to say, gee, let's put a little Buffett in there and say, what if we just could buy good companies at cheap prices. And what we did was we defined good companies. And we defined good company as companies that could earn a high return on capital. Okay? We used a particularly, what we considered a little more sophisticated measure than ROE or ROA. We looked at basically saying, what does a company need to work, to do business? It needs working capital, and it needs fixed assets. And so we said, what is their operating income divided by their working capital and fixed assets? For good, we just said, gee, the company, for cheap, we said, company earns a lot relative to the price we're paying. So you could think of that as the earnings yield or earnings relative to price, the inverse of PE ratio, however you want to think about it. We did a little bit, we looked at pre-tax return and looked at enterprise value, which takes into account the amount of debt that was